I'm going to create a new client for today, and I'll show you how we can do that, and then we'll go over some tips and tricks that might help you in creating your client plans. So for today, my client's name is going to be John Snapper. Okay, and he has a date of birth of January 1st, 1966. And he is born in the province of Ontario. And for today, we're going to keep this relatively simple, but you could add a spouse if you wanted to, just by clicking on Add Spouse. Okay, so for now, I'm going to remove the spouse, and you can see that you can progress through the slides by clicking Next on the bottom of the screen here. Or alternatively, you can also use the left navigation menu, and you can click on the next tab, which is our general page. And so the starting year for our projection is 2025. If we would be perhaps in November or December, you might wish to change this to the next year of 2026, but we'll leave that as 2025 for now. Our client's retirement age is going to be age 65, and we will show the projection until age 100. Next, we move on to our inflation rates and rates of return. And these are based on the FP Canada guidelines. So we'll leave these the same for inflation. And then for rates of return, we're going to reduce these to take into account the client's portfolio management fees. So for cash, I'm going to use 1%, fixed income 2%, and for equity, I'll be using 5%. Now, if ever you wanted to go back to those guidelines, you just can click on Use Guidelines here. And of course, you can also save your defaults here after you've made changes by clicking on Save Current Page Settings for any new scenarios that you might be working on. All right, so then we will move along to the expenses. And there are different ways that you can portray the client expenses. We're going to start with the base expenses at retirement. So these are tied to cost of living and would include things like transportation, housing, groceries, that sort of thing. So in our example here, we're going to say that our client's base expenses at retirement are $50,000 a year. And let's say the client had additional expenses. Perhaps they would like to take a trip every so many years, buy a new vehicle, perhaps every 5 years or something like that. We could enter those in here along with the frequency. And we could also choose to highlight those so that on any of our reporting, we would see those additional expenses highlighted. Okay, so for today, I'm keeping that nice and simple, and I will just omit those. And then we move along to our incomes page. So we're going to say that our client, John, has employment income of $120,000 a year. And I will leave the indexing as 0 for now. The type is employment. Yes, it is taxable, and yes, it is RRSP eligible. He's currently earning this employment income, so we can leave this field blank. And that's going to run until age 64 because he's taking his retirement at age 65. Now, something to keep in mind when you're on these fields is that if you put your mouse in the field, you will see a gear icon. And with that gear icon, you can actually be a little more specific with the date. So either he's working to December 31st of that year, or maybe he's working, maybe he's retiring mid-year. You can specify that here and then click Apply. Okay. Also, if he had a defined benefit pension plan, we could enter that here. So we would put in the description, the start age, the details if he's going to be earning that pension before age 65, and then what that amount, that reduced amount would be from age 65. We could also prorate that if he's taking his pension partway through the year. So all of that could be entered here. And for now, I will just omit that because for this presentation, we'll assume he does not have a defined benefit plan. So then we move on to our assets page, starting with the financial assets. Okay. Now, by default, they always give us a non-registered. I'm going to just delete that one for now. And I am going to add a financial asset for our client, starting with an RRSP. And that's going to have a value of $400,000. The type is going to be RSP, and we're going to give him an asset allocation of 0% cash, 40% fixed income, and 60% equity. So as you will recall, we had predefined our rates of return. So with those percentages at those rates of return, we've got a total rate of return for that RSP account of 3.8%. Moving on, we're going to add another financial asset, and this one will be a tax-free savings account. And we'll say that that's worth 50,000. The type is tax-free savings account. We're going to use the same asset allocation, 40% fixed income, 60% equity. And then we're going to add a non-registered account with a value of 400,000. And the minute that I indicate that it's a non-registered account, it's going to ask me for the cost base. So the cost base on this is 325,000, and that will be factored into any future liquidations on that account. And we will have the same asset allocation of 40% fixed income and 60% equity. All right, so that is it for the financial assets, but you will notice that there are tabs up top for the different registered accounts. Okay, so if we go to the tax-free savings account, this is where we can enter in the contribution room for 2025. So by default, we indicate that they've got contribution room of $7,000. If they've already made that contribution for the year, we could change that to 0. And if they haven't made their contributions since the beginning of, since the TFSAs, or since they were of age to contribute to a TFSA, we could put that total amount here as well. And then we move along to the RSP tab. Again, if like by default, they're going to base this on 18% of the client's annual income. But if you have a copy of the client's notice of assessment, you can obtain their contribution room for 2025, and you can indicate that number right here. If there's a pension adjustment, you can add that here. And then you also have the option to base the minimum RIF withdrawals to the age of the younger spouse, if there would be a spouse. And then here we have the RSP conversion age at age 71. But if your clients wish to start withdrawing from their RSPs and convert their RSPs to a RIF sooner, then you can certainly change that date right here. All right, we don't have any locked-in plans in this particular scenario, but there is a tab for that. There's also a tab for the first home buyers plan and the employer matching if they belong to a group plan. Okay, and next we'll move on to the real asset. So we're going to add a real asset, and that will be the home. Okay. Oh, there we go. All right, so I am going to put home here with a value of 800,000. And we'll leave the cost as is. It's the principal residence, so that's fine. We're going to say that it's appreciating at 2.1%. Now, if they were purchasing a home in the future, we could put a future purchase age here. Same thing if they were planning to sell the home in the future, we could put the future sale age here. Okay? And they're asking for capital gains tax, and no, that would not apply in this instance. Okay? Now, We could also add any other real assets. So perhaps they have a cottage or that sort of thing, or maybe they're looking to downsize a home. We could add another home here and put that future purchase age for that downsized home. And then we would have the future sale age for the original home. Okay, so moving along, we're going to go to the debts page. We're going to add a debt. And in our description, we're going to put a mortgage with a balance of $50,000. We're going to say that the interest rate on this mortgage is 3.8%. And this doesn't apply. The repayment options, we're going to go with interest and principal. And we're going to say that the monthly payment is $1,500 a month. It is not tax deductible, but we will, however, tie this to the family home. This mortgage will be tied to the family home so that if we decide to sell the family home in the future, the proceeds from that sale will be used to pay off the mortgage before we perhaps go ahead and invest the difference or fund that to our client. All right, and moving on to the next page, we have our government benefits page. So we're going to assume that John is going to take his CPP at age 65. Now, you might have a copy of the client's statement from Service Canada. If you have an amount, you can either enter in the amount that they will be receiving, or you can enter in the percentage. So in this case, we feel that our client will be receiving 100% of the CPP. So I'm going to put in 100% there, and then you will see that that pre-populates the annual retirement pension amount. Okay. And then as for the old age security, he will also be receiving that at age 65. He'll be receiving 100%, and we have the amount there. Okay. Moving on to insurance. If the client has any insurance policies, whether it's life insurance, disability, or critical illness, we would enter those here. So as an example, I will click on add life insurance, and then we could enter those here. What's a really nice feature is that for any death benefit or annual premium, if you have an illustration from an insurance company and you have those numbers in Excel, you can copy and paste them in. So that saves a lot of time. So that's a very popular functionality here. And then, of course, you can select your beneficiaries. But I will delete this for now because in our sample scenario, we will not be using any life insurance. We also have a page for any RESPs. So if you have an RESP, you can enter those details here, add your beneficiaries, and indicate information with respect to their education, the start age, how many years, and what the anticipated cost would be. Okay. And then, of course, we have our settings. So we have our portfolio settings. So for fixed income return allocation, we're saying that's a 100% interest. For our equity return, we're saying 60% capital gains, 20% Canadian dividends, and 20% foreign dividends. You can change those if you want, but again, we're using the FP Canada defaults. And then for portfolio turnover, so for example, for rebalancing your non-registered portfolios, we're saying that that would be at 5%. Again, you can make changes as the need may be. And then we have our cash balance interest rates. So for credit interest, that would be 2.4%. And for debit interest, so your borrowing rate would be 4.4%. In terms of income taxes, we do have some additional features, but those are used in rare instances. But for the most part, we're showing you here what the standard tax credits are that are being applied to your plans. So we have those here. We pay the EI premiums as well as the CPP contributions. And you can indicate here if the client is self-employed. And then if the client is making any charitable donations, You would enable this here, and then we can list unclaimed donations from previous years that we might want to claim in the future. For now, I'll uncheck that. We also have a corporations module. So if your clients are business owners and they have a corporation, you might want to activate the corporations module, and then we can pay out dividends and salaries, which would complement the personal side of the plan. But for today's example, we're not going to use that. So now, as you can see by one of our top menus here, SNAP essentially is done in 3 stages. So basically, we have the scenario set up, which we've just gone through. And if you have all your information gathered in front of you from your introductory client appointment, it shouldn't take you more than really 5, maybe 10 minutes to complete. And then once you've got all of that entered, then you move on to your planning pages. Okay, that'll just take a second to load. And my computer's just a little slow today. It normally doesn't take this long to load, so I'm not sure. I'm going to refresh my screen here. Click planning pages. There we go. Okay, so now we're on the planning page, and I know this looks like a lot of numbers, but this is essentially all of the details that we've just entered in the scenario setup on one page. So it's basically showing your client's life from now to the end of the projection on one page. So I will show this to you from left to right, and then we will go from top to bottom. So for our client John here, we have a column here for the year, okay? And then we show his age relative to each of those years. Then we have a column for the cash flow management start date. All right, we have 2 methods of cash flow management. We have automatic cash flow management that by default starts at the client's retirement, which is age 65. And that is where we SNAP manually decumulates the investment portfolios to meet the client's spending need in retirement. Prior to retirement, this is where we would normally manually input contributions to the client's financial assets. And then after those contributions are made, we would assume that any excess is spent by the client. All right. So then we move on to our expenses column, and we could see that at retirement, our client has requested $50,000 a year, and that is in real dollars. Okay. We're also showing that in nominal dollars, which provides for inflation. So you will see those amounts are gradually increasing at the rate of inflation. Okay, so those are our target spending amounts in retirement after inflation. And then we have an income column, and we can see that our client is earning employment income right up until age 64. His government benefits, so the CPP and the old age security, will kick in at age 65. Then we move over to the income tax columns, and we can see the taxable income. If we would like more information on that taxable income, we can click on this blue box here, and then we will see the details related to that. So we can see his employment income, his pensions, his deductions, his investment income, and corporate distributions don't apply in this case, but if there would be a corporation, those dividends would be listed here, and any other capital gains. All right, and so I'm just going to close that for now. And then we have our CPP and EI deductions here, the total tax payable, and again, you can click on the blue box, and you'll get more information relating to the federal tax, the provincial tax, and total tax. And then we have our marginal and effective rates here. And then we move into our financial assets. So we've got a column for our RSP, our TFSA, and our non-registered account. These are our values at the end of every year. So as of December 31st of each year, these are the values. This is where we can make contributions, and then we have the rate of return. So I'll show you how to quickly make a contribution. So for example, if we want to make a $7,000 contribution to the TFSA, we can, any number that is in blue or purple can be edited on the planning page, okay? So to edit a number, we can click on it, and then a box will open up here, a window. We can add the amount of our contribution. So I'm going to say that our client is going to contribute $7,000 a year, and I'm going to copy that down to age 64. Okay, so that's the last year that he's working. I could index it if I'd like, but for now I'll keep it simple, and I'll click the blue check mark. Now, as soon as you make a change, okay, you will know that you made a change because the cell will become highlighted in yellow. So that's how you know that it's not system generated, that it was a manual input. A manual meaning that you yourself inputted that change. And then we get a note on top here in orange that the scenario has been changed and that we must rerun our scenario because these numbers that we've put in have to be calculated behind the scenes. So as soon as you see this in orange, that means you must recalculate. So we'll click on that. It's going to rerun. And now that it's rerun, you will know because the button has turned to green. Okay, so we can see now that those $7,000 contributions have been made. Okay, and then the value at the end of the year goes up, not only because of the rate of return, but also because of the contribution made. Now, if I wanted to remove or cancel those contributions, you could click on the X if it was an individual. But if you want to cancel multiple, you could just click on that first 7,000, click on clear override, and copy that clearing of the override to age 64. All right, and then you click on your check mark, and then you need to rerun that again. Normally this happens very quickly. Today, for some reason, it's taking a little longer. Okay, I'm just going to refresh my screen here. Okay, so that has been rerun. So you can see that we have zeros now under the contribution withdrawal column, and those are no longer highlighted in yellow because those manual edits have been erased. All right. Okay, and moving along, we have a column for our real assets. So we have our home listed as a real asset, and we have the value as of December 31st of every year. We do have debt columns. So we've indicated that the client holds a mortgage. We see the amount owing every year. We see the amount paid every year. We can see that this is paid in 2027 because there is no longer a balance owing. And then we also have our balance columns. So we have our net worth. And if we click on that line, we'll get more information relating to the net worth. So we can see the value of our financial assets as of December 31st, the value of our real asset, the total assets. We see the value of the debt, which then gives us our net worth. And then same thing with the estate before tax. You can click on this line at any point, but I just want to specify that if you click the blue box at the top of the column, that gives you the estate before tax at the end of the projection, which clients often find interesting. So as of December 31st, 2066, the end of the plan, these are our financial assets, real assets, total assets, the estate before tax, the tax payable on the estate, and then we have our after-tax, estate after tax in nominal as well as in real dollars. Okay, so I'll close that. And now we're going to look at things from top to bottom. So we have indicated that our cash flow management is going to start at age 65. So at age 65, we are saying that while our client is in retirement, they have indicated to us that they would like to have base expenses of $50,000 a year. So we can see that they have income of $20,951 from CPP. They're receiving old age security of $9,892. They have tax payable of $3,452. So with all of that taken into account, we can see that they need another $29,250 to come from their investments. All right. So if you go to the top of the financial assets, you'll see a gear icon. And with that, we can show the CFM order column for our scenario. So I'm going to save that. And CFM stands for cash flow management. So there is a cash flow management order for contributions and withdrawals. So at this point, we're in the withdrawal stage. Okay. So the order for withdrawals is non-registered, tax-free, and then registered. Okay. Now keep in mind, if the client was of RIF age, we would be, SNAP would take the minimum RIF payment, and then after that, it would follow this order. Okay, but being as our client is not at the RIF age as of yet, we're going to go with the order of non-registered first, and we can see that we're withdrawing $29,250 from that non-registered account, which is the additional amount needed over and above the client's income to get them to that $50,000 targeted spending amount for the year. Okay. Now, just so you know, you could change these orders. You can click on it, and there's a drop-down menu, and you could try other withdrawal orders if you like. And then you would just click the check mark to effectuate that change. But I'm leaving it as is, so I'm just going to click on the X. So we can see here that we're withdrawing from the non-registered account right up until the age 71. And that is the age when the client converts his RSP to a RIF. And then those RIF minimum payments start the following year at age 72. So we can see here, and if we hover our mouse on that withdrawal amount, we can see that the client is receiving the minimum withdrawal of $34,297. And then the additional amount that's required to supplement the income will then be withdrawn from the non-registered investment. Okay? And if we scroll down to the bottom of the plan, we can see that the plan works at $50,000 a year. If it didn't, we would see red highlighting, and we would know that at that point, the client is in a deficit. So let's just say that the client comes to me now and says, instead of $50,000 a year, I would like $75,000. So because this number is in blue, I can edit it right from here. So I'm going to say the client wants $75,000 instead. I'm going to copy that down to age 100, and I'm going to click on the blue check mark, and then I'm going to run my scenario. All right. So now the client is receiving $75,000 a year, and we can see that they are in a deficit at the age of 84. Okay, so that means they've run out of money. Okay, they do still have their home, but you know, this is where you may have to have a conversation with your client about whether or not they want to maintain that $75,000, because if they do, they might need to consider selling the home at that point. But we also have a very interesting feature here under our recommendations tab. So if we click on the recommendations, our most popular feature here is the sustainable spending. Okay, so that lets us know how much our client can spend in retirement without running out of money. You'll find that clients will often ask you that. How much can I spend in retirement without running out of money? So we can calculate that right here. So I clicked on calculate, and then I get the answer that the client can basically spend $56,519 per year, which is 18,481 less than that 75,000. So you can apply and run, but before you do that, I would always recommend that you copy your scenario, because once you apply and run this, you can't go back. Okay, so by copying it before I apply and run it, I will then have two scenarios, which I can later compare. So copy and then apply and run. So now our base expenses have changed from 75,000 to the sustainable amount of 56,519. Okay, and if we scroll down, we can see the plan works. Okay, so now what I wanted to show you next was the compare scenario feature. So you can see here that we are on the base scenario with sustainable spending. Okay, and with through these three lines here, we can either switch scenario to go back to our base scenario. We can compare the two scenarios. We can rename scenarios to make sure they're reflecting what it is we want to show the client. We can copy scenarios and delete scenarios. But for now, I want to compare both scenarios. So I've clicked on that. And this usually takes just a few seconds. So we'll see what's happening here. Okay, so compare the scenarios. Let's try this again. Yeah, it's fast now. Okay, so what we do is we select both of them, and the maximum scenarios that you can compare is 5. So once you've selected the scenarios you wish to compare, then you hit compare. And now we have a table where you can see different metrics. And then you can see the base scenario, the sustainable scenario, and then the difference. Now, keeping in mind with the base scenario at $75,000 a year, we were only reaching 64% of our goal. And here with the sustainable spending, we've reduced the amount to the 56,000 and we're reaching 100% of our goal. We can sustain that level of spending right to the end of the plan. Okay, and then it's also interesting to look at it from, the personal estate point of view. So how much you will have at the end of the plan. So when in the basic plan, when we were spending 75,000, we were running into a deficit. And then with the sustainable, we still have real assets. So you'll see that our financial assets have pretty much been depleted because we've asked the system to tell us how much we can spend based on those assets. So that's what it's done. But we still have our real asset. And so at the end of it all, we don't have any debts and our estate before tax is 1.9 million. You can also look at this in chart format. Okay. So which is also interesting. Some people prefer to look at numbers, some people prefer to look at graphs, but you have those two options available to you. Okay, and then we also have charts that we can show our clients. Our charts are very interactive. So here we have the cash outflow chart. So if you want to see in the legend, you can see what our outflows are. So we've got base expenses, so how much we're paying out to our clients in the form of the base expenses, how much they have to pay out in income tax, how much debt payments they are making, which we see in the first 3 years till that home is paid off. And if you click on those words in the legend, then it highlights those amounts. And then we also have the total inflows. So what we can see here is that at no point do our outflows supersede our inflows. So we're never in a deficit. The plan is working. So that's what we like to show our clients. And if you put your mouse on any of these bars or this is a bar graph. So on any of those bars, you'll get more detail, okay, relating to that point in time. And then we've got our cash inflow chart, so we can see the employment. We can see the old age security coming in, the CPP, the RSP RIF income, TFSA, and of course the non-registered. And then this is the tax that's payable. We've got our net flow chart. So clients also like to see their net worth. I said net flow, I meant net worth. So we've got the non-registered assets, TFSA assets, registered assets, real assets. They only have a little bit of debt at the start of the plan. They don't have any insurance. And then we have their overall net worth. So yeah, those are our charts. And the last one is our asset allocation chart. So basically, we're in a 40-60 split between fixed income and equity. So clients like to see that as well. So I'm going to exit this now, and then we will go to our client reports. And our client reports are also done in 3 steps. So we've got our report builder, which is where we can include pages that we want to present to our clients. And then we have a gallery here. So for right now, I've got all of the pages in my report, but if I would want to remove them, it's very simple. You just grab and drag over to the gallery, so that removes it. If I want to bring it back, I just slide it over to the left. I can also change the order by sliding my pages. So that's very simple. We can add custom pages. Sometimes clients like to add a table of contents or maybe an appendix. We've got header settings, so maybe you want to number your pages, maybe you don't. If you're recommending one scenario over another, maybe you want to put the name of that scenario. So perhaps take CPP at age 70, take CPP at age 60, that sort of thing. And of course, your print settings. Once you've got that figured out, then you can go into your report editor. You can make changes to your cover page. Your note to your reader, that is more of a disclaimer, so you'll likely leave that as is. And then with respect to our snapshots, you might want to change some things, add some things. And then, there's different details there. We even have a recommendation page. So maybe you want to add some recommendations. So perhaps you're recommending that they consolidate assets. Perhaps you're recommending that they convert their RSP sooner. You're recommending that they maximize their RSP and TFSA contributions every year. Those sort of things. Add beneficiaries to their registered plans. Things like that can all be entered in here. Once you're satisfied with that, you can preview your report. So this is what the report would look like. I did forget to mention under Report Editor that you can, under the cover page, add your logo. And then we have different backgrounds for you to choose from. So going back to Report Preview, you'll be able to see what the report actually looks like. And these are what we call our snapshots. Okay, so they're like little summary cards that our clients generally like. And then of course we have much more detailed pages. So these are our assumption details that you'll want to include, very important. And then we have charts and we have tables that you might want to go through with your clients. You can change the language of your report as well. And then of course you can generate your PDF so that you can either save it, print it, email it, that sort of thing. So in a nutshell, that is Snap Projections. So I'm going to stop sharing my screen and I will ask if there are any questions. So if you do have any questions, we do have a chat box on the bottom. And then to your left, there's a webinar chat screen. And you can either make your question visible to myself or to everyone. You probably just might want to send that to me, and then I can address those questions as they come in. So I'll give you a few minutes to enter in those questions. Maybe there's something I missed. Maybe there's something you would like more clarification on. or maybe there's something that interests you over and above what I've presented. I don't see any questions coming in. I'll give you a little more time. So maybe I'll go back into my Snap here and just make sure that you're aware of our Help Center. So if you go to the top, you'll see the word help, and you can click on our Help Center. And we have a vast array of resources in here. We've got articles, webinars, videos to get you going. We have tiles with different topics. So maybe you want information on assets and debts or contribution and withdrawals, creating reports, corporations. You can click on any of those tiles, and we have lots of information to assist you with any questions you may have, provide you with step-by-step instructions, that sort of thing. You can contact us at any time. Our telephone number is here. If you are French speaking, si vous parlez français, sélectionnez l'option 3. And then if you want to contact us, you can always reach us by email by clicking on contact here. And we do strive to return all calls and emails as quickly as possible. And whatever you need, we're here to help. We want you to be successful with Snap. Just going to go back and check to see if there were any questions. So I don't see any questions here, so I will leave it here. But if you think of anything after we sign off here, like I said, give us a call, send us an email, and we're always happy to help. We want you to be successful with Snap. So thank you for joining today, and we look forward to assisting you in the future. Thank you.